Hey everyone, this is Eddie, and today I'm talking about cover calls to boost your monthly cash flow if you own some stock. Um, by that, I mean if you own certain stock which has good liquid options markets, you can actually sell the upside and cap your upside a little bit to collect some monthly premium. Let me take you through an example of what I mean by this market. So let's go through an example here. This is my trading account. I bought this Apple stock a while back, a few reps in um, on some other videos I was creating. So the trade price for me for this stock was $100. Sorry, 100 quantity, and then I bought it for 200 each. That's the amount of money I paid to get this stock. Now, what do we do once we have this? And I also want to show you, I was running a short put on a very small stock just to show people how they can do it in a very small account, which is a $5,000 account. And I picked up Hewlett Packard and I sold a short put on it. And I'm already up 75% on it. And I'll show you exactly what I did. This was a short put on a small stock for a small account. But today we're talking about the cover calls and short puts. I'll give you a brief of the short put that I have in my account as well. Let's go through a cover call first to boost your cash flow, like a monthly cash flow on the stock that you own. You own Apple, right? First of all, we need to pick the right expiration cycle and then the right delta to sell that. My go-to here would be if you look at the expiration and then implied volatility in all these cycles here, this percentage number is the implied volatility, and the number in the bracket is the expected move from where it is right now. The further out you go, the bigger that move is, because then the stock has more room to actually go either up or down, and therefore that number is in plus or minus. What this thing is saying is it can move $16 from here up or $60 down, depending on how the market goes. The implied volatility in this cycle right now at all is 25%. We can confirm that if we go to the charts here and then look at this number here. It's roughly the same. This is the current implied volatility in Apple. Okay, let's go through here. Pick the cycle that we normally trade, which is between 45 to 50 or 35 to 50, I would say. I would even sell something, but it's 37 days out or 38 days out, depending on how the volatility is. Right now, the vol is low. If you were to do an average of this, the average vol in Apple, if I were to run that, is 30. Okay, it's trading at 26 right now because the market has been really bullish. This is where it was at 34, and it's been dropping down since then. What do we do here? We pick the cycle, 48 days, perfect expiration. Then the first thing we check is the volume and open interest. Now look at this volume and open interest here. It's in thousands. That's what you need to look at. Every time you look at this thing, you just make sure that this thing is in thousands. The further in the money you go, less volume and open interest you get. But out of the money, it's always more liquid because that's what people buy and sell. Okay. What's next? So selling the upside here, my cost basis is around 200. So the stock is way above my cost basis, which is perfect. Now here, what I need to decide is at what point or at what level do I need to let this, or can I let this stock go away from me? It is trading at 232. And if I go at 232, if I go maybe 30% out, that gives me $300. That's a big move from here. Okay, 300. You in this cycle you will not get enough premium at 300. You can see that here. My go-to cycle would be around 19 delta, which is 250. If I'm willing to let the stock go away at 250, what did it give me? The percentage move on the stock is 7.75%. Okay, totally fine. From my cost basis, and just keep that in mind that I've collected more premium since I've held the stock. So include all that premium, include the price move from where you bought it at, and that's where your net return will be on this position. Now, from 200, if I let it go at 250, what kind of move do I get there? And that's a 25% move, right? That's a 25% move in a stock that I'm holding, and I have been able to get it at a good price. Another thing that a short call does, or a cover call does for your position, is cut down some of your risk. Right now, my delta, my open delta in the Apple position is obviously 100. I don't have that here, but I think I should bring it in. Some reason I don't have delta. Beta. It's coming up. Beta. Let's move these two up here somewhere near we can see right next to the price change. Okay, so the delta of my position is obviously 100 because I hold 100 stock. Each stock gives you one delta, meaning obviously if the market moves $1, your stock position will move $1 with it. Okay, and you don't have any theta because you haven't sold any stock here, but you haven't sold an option here. So what do I do here? In order to cut my delta down a little bit by 20 and have a net 80 delta and then cap my upside, I can sell this, which has got a good open interest of 22,000 contracts and 3,100 volume on Friday, August 29th, 2025. So let's take a look at this position. Let's bring this thing down to the one contract and see how this thing looks with your overall position. The first thing you'll need to do is change your break even to the expiration cycle. And I'll show you a couple more things here. You can look at this probability range. This means that this is a one standard deviation move. From here, one standard deviation out, the probability range is obviously 68%. So 68% of the time, the stock is supposed to stay within one standard deviation of its mean. And that's where we sell it as well. We almost sold it at one standard deviation, just a little bit further in, because that's where we get, at one standard deviation is where we get good premium. Now you can change this to 2 or 3, depending on how you want to look at it. But one standard deviation is the go-to spot for us, the way we sell options. You have a 80% chance of winning in this because you picked up 20 delta. So that gives you, that's right away, it gives you 80% chance of being in the money or being profitable in this trade. And the overall net credit that you will collect is 176. Now, because that's what the premium is. Now, you also need to understand that you will pay some commission to get into this trade. The commission that you'll pay that I'm set up as is 65 cents per option. This is to get in, and then 65 cents to get out. So two trade commissions here, 65 cents each, excluding any rolling, adjusting, or anything with the option. You can just take a look and then see how many contracts you want to do based on your account. For every 100 stock, you should only sell one option, because if you sell more than that, you will be charged more commission. And let me show you that. Here, my buying power effect is 0 because my position is covered by the stock that I hold. So one option contract here is covered by the 100 Apple stock that I hold. Now, if I change this to 2 contracts, if I just change this quantity to 2, then look at the buying power effect now. Now, it's not even letting me do this because I don't have the extra 100 shares that I need. So in order to do that, you can sell uncovered calls, meaning you just sell naked calls, and your broker will actually tell you the commission based on that. But I think because the markets are closed right now, it's not giving me the right margin number for a naked cover call. Okay, for a naked call, we've checked everything. It is okay. The point that I will take it off at is once this thing goes up by 50%, meaning when this option is trading at, let's say, about $1 or slightly less, 90 cents or 80 cents, that's when I will take it off. So from 176, I will take off. I would collect 50%. So 50% of that is 88 cents. So let's say the option is trading at 88 or 90 cents. That's when I will buy it back at. Keep my premium and keep doing the same thing again and again. And that gives you a good net ROI, because look, you did not put any money down, right? You already have some stock in your account. All you did was just collect premium here. So you're collecting $90 each month. Remember, you're doing this for a 48-day cycle, and then before the end of the cycle, meaning when there's 15 to 20 days left, we would roll this. So we close this out. So our net window to collect this premium is basically 25 days or 23 days in the cycle, which means it's less than 1 month. So you're doing this every month. Now, if your net ROI is, if that's what you do every single month, and you have a 20% chance of losing, meaning if you do this for 10 months straight, you will lose 2 months out of it, and you will be profitable for the remaining 8 months. And therefore, that's what the math says, and that's how it actually works. In the long term, it's all about the numbers game. The number of occurrence that you have in your account, that's how you become good at this thing. How to defend this? That's a bigger question. How to defend this position if this stock goes up? Now, you've already decided that you are willing to let it go at 250. So let the stock go through your strike because you're already comfortable letting it go at 250. So I would let the stock go through my strike, which is the short strike, and let it go up and let it get called away. So at that point, you will give up the stock um, in exchange for this premium that you will collect, which is $176 that you will take up, right? Which means your net cost basis will go even further down. So from 200, because that's where you bought it at, you can deduct 176 minus. Remember, I've already sold 2 or 3 couple calls already on this. So you take out another 150 and another 150. Well, I did not collect all full 100% of those premiums, but you can take out maybe 150 total. Okay, so your net cost base is like $196 in the stock, and you're letting it go for two. You can if you're letting it go at 250 and your net cost basis is 195, let's say, you have made 28% of the stock. Let the be called away. You've kept the premium a few times, and that's it. Fine. You made 28 to 30%. Now, I will let the market drop down a little bit. Just wait for a good entry point. Look at the chart, see where the price action is, and look, it's not at all-time highs, but when it comes down to its moving averages or slightly lower, that's what I would get in again. You can see that 200 looks like it's bottom here for Apple, but it has gone through that in April when the volatility was really high, all tariff news. But after that, it hung around at 200. I would look at a couple of the metrics before get in, but that's how I will treat this position if I had it in my account. Any other questions? Just let me know. Let's talk about the HP position. This was for a small account. Nothing special about it. Just sold a short put. Probably the same time. Now it's time to take it off. Look, it's 20 days out. This is where I take it off. And it's already trading at 10 delta. I probably sold it at 20 or 25. What strike did I sell it at? The strike was, it's 25, sorry, 19. I sold it at 19 strike, which is here. Oh, I can see that here. But then at that time, it was probably trading at 20, 25. Good open interest, good volume for a very small amount account. You should definitely trade this. Look at this. Volatility is high. This is probably because the earnings are coming up, but always keep an eye on the earning cycles and where the stock is going from here. Other than that, yeah, that's the short put. Just sold a single short put to get assigned first, and then sell the cover call side, meaning that's how you run the wheel strategy. Now, there are some risks on the short side too, meaning it could have gone through my short strike on the downside. Here it went up, but it could have gone through my short strike on the downside. So I decided that I would get assigned at 19. So I would keep that. I would hold it. I would hold the stock until it goes up beyond my cost basis, and then I will start selling the calls. Because right now, if the stock goes down, and let's say it's trading at 17, you bought it at 19, so that's already a $2 loss. You'll have to wait until it comes up to 2021 before you can sell the calls. And then selling calls mean you will sell it at 25, 24, somewhere around this mark. This is what I would do. Not in a 20-day cycle, in a 48-day cycle. So in a 48-day cycle, I would sell it at about 26. That's a good premium. I'm at 25. Right. This is for a small amount. For a small account, you can start with $5,000, and then you only need to spend $2,200 to get this going. Keep the rest in dry powder. If there are other opportunities you can take, and also you have to keep money for some adjustments for mechanics and rollings, the rolls that you do. Let me know in the comments if you want to know anything else about cover calls or short puts or anything else. Thank you very much for watching. Bye-bye.